studying your last two. I swim med when turned in. The styren down to mute. And can learn the pole that sunk he died.
When learning corporate tax, one of the most important concepts to understand is the relationship between connected corporations and intercorporate dividends. At the center of this slide is the corporate profit pipeline. An operating company, often called an Opco, earns business profits through its day-to-day operations. Instead of leaving all of those profits inside the operating company, some of the money can be paid as a dividend to a holding company, commonly known as a holdco. The holding company can then use those funds to build wealth, purchase investments, or hold assets separately from the operating business. Eventually, the profits may be distributed to the individual shareholder, who is the ultimate owner of the corporate group. Now, why does the Canadian tax system allow this flow of money? The government's objective is called tax integration. Without special rules, the same profits could potentially be taxed multiple times. First inside the operating company, then again inside the holding company, and finally when the money reaches the individual shareholder. To prevent this type of double or even triple taxation, the tax system generally allows profits to move between corporations without creating another layer of regular corporate tax. This is why dividends paid between connected corporations are often received tax-free at the corporate level. The goal is not to eliminate tax entirely. Instead, the goal is to defer taxation until the profits ultimately reach the individual shareholder. A useful way to think about connected corporations is to imagine a corporate family. The operating company and the holding company are simply different members of the same family structure. As long as the profits remain within that corporate family, the government generally allows the money to move through the system without imposing multiple layers of corporate tax. This concept forms the foundation for understanding connected corporations. Intercorporate dividends, Part 4 tax, and the ARDTO rules that we will explore later. In the next section, we will learn exactly what makes two corporations connected under the Income Tax Act. Now that we understand why connected corporations are important, the next question is simple. How do we determine whether two corporations are actually connected? The Income Tax Act provides two main tests. If either test is met, the corporations are generally considered connected. Let's start with test number 1, the control test. This is the simplest test. If one corporation controls another corporation, they are connected. For example, if Holdco owns 100% of Opco, Holdco controls Opco because it has all of the voting power and can direct the corporation's decisions. In this situation, a connected corporation relationship clearly exists. A useful way to think about control is boardroom power. If one corporation has enough voting shares to elect directors and make key corporate decisions, it generally controls the other corporation. Now let's look at test number 2, the 10% ownership test. Even if one corporation does not control the other, the corporations may still be connected. To satisfy this test, the recipient corporation must own more than 10% of both the voting shares and the fair market value of all issued shares. Notice the word both. Owning more than 10% of voting shares alone is not enough. Owning more than 10% of fair market value alone is also not enough. Both conditions must be satisfied. In our example, Holdco owns 30% of the voting shares and 30% of the fair market value of Opco. Since both percentages are above 10%, the corporations are connected, even though Holdco does not control Opco. At the bottom of the slide, notice the ownership thresholds. When ownership is 15%, 30%, or 100%, the corporations are generally connected because they exceed the required threshold. However, when ownership falls to only 5%, the corporation is usually not connected. Instead, it is treated as a portfolio investment. This distinction is extremely important because connected corporation dividends and portfolio dividends often have very different tax consequences. Here's a quick memory rule. Whenever you see dividends moving between corporations, ask yourself two questions. First, does one corporation control the other? And second, does the recipient own more than 10% of both the voting shares and the fair market value? If the answer to either question is yes, you likely have a connected corporation relationship. Understanding these two tests is critical because they determine whether special rules involving intercorporate dividends, Part 4 tax, dividend refunds, and ARDTO will apply later in the tax calculation process. In the next section, we'll see why this connected corporation status matters by comparing connected corporations with portfolio investments. Now that we know how to identify a connected corporation, the next question is, why does connected status matter? The answer is that connected corporations and portfolio investments are treated very differently under the Canadian tax system. Let's start with the left side of the slide. Here we have a typical Holdco-Opco structure. Holdco owns 100% of Opco, making the corporations connected. When Opco pays a dividend to Holdco, that dividend is generally deductible under Section 112 of the Income Tax Act. As a result, the dividend can usually move from Opco to Holdco without creating another layer of regular corporate tax. This is one of the key benefits of a connected corporation relationship. In many owner-managed businesses, this structure allows profits to move from the operating company into a holding company for investment, wealth accumulation, and long-term planning. Now let's compare that to the right side of the slide. In this example, Holdco owns small investments in various public companies, such as bank shares, telecommunications shares, or other publicly traded stocks. Notice the ownership percentages: 5%, 3%, small minority interest. Because Holdco does not control these corporations and does not own more than 10% of both the voting shares and fair market value, these investments are generally not connected corporations. Instead, they are portfolio investments. This distinction is extremely important. Unlike connected corporation dividends, dividends received from portfolio investments may be subject to Part 4 tax. In other words, the tax consequences can be very different simply because the ownership relationship is different. The key idea is that connected corporations are viewed as part of the same corporate family, while portfolio investments are viewed as outside investments where the corporation is simply acting as an investor. Take a look at the ownership examples shown at the bottom of the slide. When ownership is 100%, 30%, or even 15%, the ownership generally exceeds the connected corporation threshold, so the corporations are connected. However, when ownership falls to only 5%, the investment is generally considered a portfolio investment rather than a connected corporation. Here's an easy exam memory rule. Most Holdco-Opco structures are connected corporations. Most small investments in public companies are portfolio investments. Whenever you encounter a corporate dividend, one of the first questions you should ask is this dividend coming from a connected corporation or from a portfolio investment? That single question often determines whether special rules involving Section 112 deductions, Part 4 tax, dividend refunds, and ARDTO will apply. This distinction forms the foundation for the more advanced corporate tax concepts that follow.